answer the debt part first, and I've had a personal experience in this because as part of the Chili's business that we are running, we're also trying to raise debt. So in the past 1 year, I've been talking to banks, and I've had a great personal, reaction from them. And I think the first meeting we had, people just listened to us for 2 minutes and said, "Sorry, we don't invest in restaurant business," and walked away. And these are big banks, the tier one banks. And I think we scratched that layer, talking to them on a personal basis, and we kind of figured out the reasons for them to react like this has been that they've kind of burned their fingers in the past a lot. Two reasons. One, this business in the past has been a very cash-oriented business, where all the customers were paying in cash, and then handling of cash leads to issues around what is being reported and what is actually being the sale. So banks had a really bad experience in some of those in the past. And I think secondly is that it's the asset that is being purchased is kind of a sunk asset. Because if you're spending 40% of the capex in a restaurant, in the civil and the plumbing and fit outs, you can't really recover that cost once you want to, if your concept goes bad and you're a shut shop, that's money which has gone down the drain. So the banks, if they've given a loan, they can't really possess the property and liquidate it and recover their money, because once the restaurant is fitted out, almost 40 to 50% of that value is eroded on day one. So those are the two concerns. Now, what's our experience is that with this change of credit cards becoming more popular, it's helped the cause a bit. And I would encourage our fellow industry to explore the bank route a little more as well now. And what we've done is that we've kind of offered all our credit card receivables as a collateral. So that kind of helps them, because in a typical model like casual dining of Chili's, investment to revenue ratio would be anything between 1.5 to 2 times. So if you're able to give them the credit card receivables, they're pretty happy to look at and consider a part of the investment as a loan. But the second question around, why should a PE investor look at if the bank is not looking at it? So I think again, the two reasons why the bank does not, the PE investor looks at, for example, in our case, we've done a control deal. So we kind of own and operate the business ourselves, including the company as well as all the stores. So that enables the fund or the investor to actually put in our own management team, and gives it complete control on how what kind of food we are serving, how we are serving it, and therefore manage the cash flows. Right. But inherently, if you've seen the last year, there's been a slew of activity around PE investments in the F&B sector. There is Moshe's, there is Barbecue Nation, which has happened. Papa John's, we sold our business to another group. So there's enough interest and excitement from investors simply because it's a good cash flow business. The returns are there. The fundamentals of this industry are lock in place. We are far, far away from the kind of eating out behavior we see in developed nations, and so that growth is definitely going to yield a good cash flow. And it's most of these businesses, especially our focus is around the casual dine sector more than the quick service, because casual dine, you're finding that it's profitable in the first year. And if it's not profitable in the first year, then it's never going to be profitable. So while QSRs, because of the nature of the beast, you need more economies of scale. And unless you've reached like 20 or 30 outlets in a city, you don't really become profitable as a unit. Right. So like Yamendra said, a large chunk of your restaurants are, kind of subsidizing the ones that are not making the money, which will happen. But in a casual dine sector, 1 or 2 stores, even if you have in the city, both of them are profitable, just because the economies of scale is not that critical in the whole cost equation.
Sure. Also like you to tell us a little more about Chili's and how TVS Capital kind of invested into Chili's in the first place, and where does the growth look like?
So our experience, TVS Capital had invested in this company, Om Pizza and Eats, which had the development rights for both Papa John's as well as Chili's Grill and Bar. And TVS looked at both and found it attractive. Over the years, what we realized was that, the Papa John's business, again, as I said, is more capital intensive
Right.
to generate returns. So you need, like, for example, 20 or 30 Papa John's in a city to be able to generate money on the whole. And we being a 600 crore fund, we didn't have that kind of capital. So the fund decided to actually split the two and hive off the Papa John's investment and continue to look at Chili's Grill and Bar because, touchwood, we're finding that the customer acceptance for Chili's is great. We are kind of number one in all the catchment areas that the Chili's stores are present in terms of sales. And, that's the sector that we want to focus on. And it's helped us in a way to bring focus on Chili's because last year we separated the business and our business has grown almost 40% over last year.
Right.
And the only thing I can attribute this is to single focus on the brand.
Right.
With Papa John's it was 40 units to manage along with 5 units of Chili's, and Chili's never got that kind of focus from the fund side. So it's helped us to kind of separate the two businesses, bring the focus onto only
Single
Chili's.
business.
And from a cost perspective, yes, it's been a slightly disadvantageous. But since the majority of our cost is food and rentals, on an overall company basis, it doesn't really make an impact
Sure.
so much.